We are being joined by Mr. Jitendra, who is the Chief Investment Strategist at Kotak Alternative Asset Managers. Hi, Jitendra. Very good afternoon, and thank you so much for your time. First up, help us with your take on the markets. A lot of these points that are there in terms of the earnings as well as the Trump taking over. How you read into the market, and are markets in for some more weakness from these levels?
Hey, hi. Thank you for inviting me on your show. I feel that market has corrected with two factors. One is the earnings downgrades that we have seen in Q2, and we think that most part of this slowdown in macro is behind us, and from here onward we might see some acceleration. And for that, I think 1st of February the budget is extremely important. How the government maneuvers the economy, whether it will be an investment side or whether it's really consumption side. So that remains to be seen. But net, I feel that the large part of the earnings downgrade led by slowdown in growth is mostly factored in. Probably we'll see another 2 to 3% cut in earnings. So that's on the domestic side. So I feel that we are largely at the bottom of the downward cycle or downward revision in economic projections as well as on the earnings side. Coming to international market, I think there's too much of hope that is built into US, right? So since September, if I see, the US yields have gone up by almost 120 basis point, and even the dollar index has appreciated by 8.5 9%. That's a pretty sharp move that we have seen in yields and as well as in the dollar side. In anticipation that when Donald Trump comes in, he is going to charge a lot of tariffs, inflation will go higher. But at it, what we understand is that we should not look US in isolation, right? So most part of these companies, a large part of the US companies, they earn their profits abroad. And if a global slowdown because of these noise, because of this sharp move in dollars and the yields, I think we will see some slowdown impact on the US earnings as well. Secondly, US is trying to cut their fiscal spending, almost $1 trillion a year. That is a massive headwind to domestic growth. So all these hopes that is built into stronger dollar, higher yields probably might starts to unwind in the next couple of months as traders starts to book profits on their positions. So I feel that from a global perspective also we might see dollar starts to weaken a bit going ahead, and yield starts to cool off as the slowdown impact of global economies might starts to visible. And hence, I think these are the factors that we feel that another 2 3% downside possible, but large part of the correction in the large caps at least seems to be over. And I feel that this correction probably lasts for another month or so. But we feel that as we go forward, the acceleration in growth, especially in the rural and government stimulus that we expect from the budget, might lead to some stability in Indian markets.
Mr. Goyal, hi, this is Ankita joining in. Good afternoon to you. It's good to know that the markets are finally could be bottoming out, and perhaps the second half of this year could see a better outcome than it is right now. But let me come to you, on a more specific question, on a stock specific question. The Nifty heavyweight Reliance that has reported its results. Now, it has reported its highest ever EBITDA in this quarter. The valuations have been the cheapest since, the COVID lows, and, RIL has really underperformed the Nifty by a good 15% last year. Is it time for re-rating, because the margin, the refining margins are seeing a rebound, and also the retail is likely to revert to its double-digit EBITDA growth? Will you see a re-rating in Reliance this year?
Ankita, I can't talk specifically on stocks, but I'll just highlight my views here. How we look at this large and these big companies. So we do feel that if you look at the stock that you mentioned as well as the banking side, there the large caps. If I look at even there, the valuation is lower than the historical average, while the mid and small caps, where we have seen the valuations have actually expanded. So just to give you perspective, the mid cap index is trading currently at almost 29 times PE ratios, while the large cap is somewhere around 19 times PE ratios, right? And I feel that look, this large cap portion is actually a little bit on the better side in terms of valuation. There is a valuation comfort, and hence I feel that look, there could be some rotation happening, and it's already visible. That rotation might happen towards the large caps, and hence our house view is also that one should start to build positions in large caps, up to 80% and 20% in mid cap. So we remain positive as a house on large caps where stocks have fallen, valuation is reasonable. And I feel that in the next 3 to 6 months, these stocks might lend support to overall market as well as the portfolio. So we do believe that this is the time to go for large caps.
Right, believe that it's time to go for large caps, and in the portfolio one can have 80% allocation to the large cap and 20% to the rest maybe. And but Jitendra, also help us understand the rotation part that you were just talking about. How do you see the sector rotation, and any sector that you can flag off where this particular year maybe belongs to that sector, if you wish to highlight a couple of names there?
Yes, so I think, see, last 10 years, it was very clear that, look, government started with a capex of almost 3 lakh crores. Now, today, the central government capex budget is about 11 lakh crores. The last 10 years, we have seen that it was a one-way kind of a move where, mid and small caps, which are into niche businesses, roads or railways or defense, all these infrastructure and investment-led sectors have done really well. I feel that still budget and government will give support to infrastructure going ahead. However, the acceleration that we saw in spending will not happen. Last 2 years, we have been writing that look, government is going to feel trouble, or you can say it's struggling to spend so much of capex, right? So last year also they revised their capex target by around 50 odd thousand, and this year also clearly the government is expected to undershoot their capex budget. Going ahead, I don't see major acceleration in capex spending. But if I look at the stock valuations from 30 or 15, 20, 30 times P ratio, they have even gone up to 50 or 80 times P ratios. So I feel there is now a fatigue in the infrastructure space where I feel that results could be okay, but the kind of growth that one was expecting probably may not come in. On the other hand, the consumption part on the rural recovery stocks, they have not seen any good interest, or they haven't seen major buying interest from the investors. And what we feel in the next couple of months, it will be very clear that the Kharif output is expected to grow robust. We also see that because of good reservoir levels, the Rabi season also might be very good. So on the agri recovery side, we feel that some of the rural consumption story might come on in the next 3 to 4 months. We already started to see some kind of green shoots there. I feel that some good rotation might happen on that side. The second story that we feel might emerge is on the real estate side. Already the stock did so well. However, given the interest rate outlook, which is continuously changing from cuts to now hikes, some of the real estate stocks have corrected dramatically. And we feel that this cycle is going to last longer. Obviously, it's not going to be so robust that we saw in the last couple of years, but the cycle is turning. And I feel that, look, one should look at this real estate stock on correction, especially on the Feb 7th when we have RBI policies, and on 1st of February when we have budget. We might see some support to low cost housing or housing sector as a whole, as it is a very critical segment for the economy as a whole. So we are positive that there could be some recovery in the short term in the consumption space. However, if I look at slightly longer term perspective, right, from a 2 3 year perspective, this consumption story, might see some kind of headwind in terms of margins. So the margins, we have to be extremely careful here. We think that FMCG margins are on a declining territory. So be very selective on the consumption side, especially let's say, mall operators, we are extremely positive. Airline companies, we are positive. On the consumer discretionary, the hotel industry, we think that is on the up move, and we think there is more upside left in the hotel industry as a whole. So I feel net you have to bifurcate what kind of consumption story you want to play, as government is now clearly going to struggle to spend so much of infra spending. But that
Certainly.
spending might come to support consumption in going forward.
Definitely take your point, and just wanted to get a more sense on this rural consumption slash recovery story that you're talking about. Can FMCG staples is something that you will be looking out for, or maybe in the auto space, can somebody look at the tractor space as well? Because of late, a few of these fund managers and investors are also flagging of this space to be attractive. Just wanted your thoughts on same.
Yeah, so in terms of rural recovery, you are right. Tractor segment looks decently positioned. We have also seen, as I mentioned, Kharif output is expected to be somewhere around 4% up. So rural recovery probably is a good play. And if I look at the auto sector, we have been negative and underweight on this sector. But now looking at the correction that has happened, and generally the March quarter is good for four-wheelers and even for CV cycle as due to the depreciation benefit that they get. I think a March quarter should be very strong for auto companies, and also government might started discussion on pay commission, right? So salary hikes for government employees. I think there are some like 4.5 million government employees on the central, and 6.5 pensioners that are going to get some kind of support. So I think salary hikes in government, employees, central government, that's a little bit of a thematic or a little bit 2 3 year story where generally the four-wheeler companies starts to do better when these kind of stimulus takes place. So net, I think auto sector valuation, you have to be careful, but you have to take some exposure or starts to bite this sector a bit. However, from the global perspective, we still remain negative. So auto ancillaries, which are exposed to global sector, we think there is a lot of glut in the global auto sector, and I think there you have to be a little cautious. But from a domestic side, you are right. Tractor and CV players, especially CV financiers, that we feel that are in a better position in this market.
Right. Also, Mr. Goel, if consumption is likely to pick up and the growth story is intact, then the banking names should start moving. What's your take on the banking sector? Because, there's been fair bit of correction in the banking pack, and within the banking and the financial space, what is interesting you, the PSUs, the private banking names, or the insurance space?
It's a very tricky, sector to be in right now. There are two parts to it. One, banking side, if we look at overall microfinance book is still going to struggle. So another 2 to 3 quarters, we think it will take to stabilize, and stock price probably might bottom before that. But another 3 to 6 months, I feel that one should avoid this sector. Second, if I look at the unsecured loans, the personal loan, that has been doing pretty good. And now because RBI has started to crack down, and also there was a lot of euphoria in terms of personal lending. So I feel this microfinance and personal lending, unsecured loan, I think there's some stress, and you have already seen some of the results that came out. But PSUs are a little bit less susceptible to this side because PSUs are not into microfinance. They are also not, lending very aggressively. Have lent aggressively in the past to the unsecured personal loan side. So I feel net PSUs are better positioned in this kind of environment. So our preference is for PSU banks where the valuations have corrected and their exposure to personal loans and microfinance is a little lower than the private sector banks. But overall, if I look at banking sector valuation, that is cheap. So some of the large private sector banks are trading at valuation which is below the pre-COVID levels, and hence I feel it's a buy on dips kind of a story where you have to have patience. I think another 3 to 6 months of pain, and once the consumption story starts to pick up, especially due to salary hikes or job creation, and macro slowdown is behind, and we see some acceleration. So in that bargain, we feel that banking sector may come out, out of this woods, but it might take another couple of quarters to see complete recovery in the banking sector as a whole. RBI is very critical of what decisions they take. There's a change in governor. So we feel that February rate cut probability has actually gone down because what is happening in US. However, it's not completely out of window. And in case we see some more liquidity easing and followed by the rate cut probably in February or in April, we see that banking sector should bottom out and during that time. So I think you need to have patience here, accumulate the stock on corrections. But net end, I think in the near term, PSU banks are better positioned than the private sector bank in terms of fundamentals.
The take coming in on the banking space, but Jitendra, the kind of bashing some of these IT companies are getting, share your thoughts on the same, because there were a lot of hopes that were building in from the IT space for the past 2 quarters at least, but now when the numbers are fairly decent, the guidance have been raised, now the analysts are trying and debating the fact that maybe HCL Tech has come out with a decent set, but the valuations are not supportive, and so is the case for Infosys, where in the next 2 quarters there could be a bit of a margin pressure. What's your reading on the IT space? Is the sector overdone now, or maybe in the next 2 to 3 quarters the sector can once again get in charm? What are your thoughts?
I think IT sector has been a good hiding spot for fund managers, since September when the yield started moving up and dollar starts to strengthen and rupee starts to weaken. And also Q2 was bad, and there was a clear commentary from the management that they are hopeful that you might see some recovery. So most of the fund manager, most of the investors were focused on IT to find shelter, from this market correction. And hence when the result comes in, and you see that results were decent. I don't see that it was so bad, but there was excessive positioning happened before the results, and hence there is some correction. But I feel if I look at the kind of numbers that they have projected, and also the outlook commentary has been pretty strong. Order wins have been pretty strong for some of the companies. So we feel that yes, the valuation is expensive for large caps, but some mid cap companies here, especially in the IT side, you have to be little careful what stocks you are buying. But net, I feel from a 2 3 year perspective, this is a nice opportunity to get into this story as U.S. economies, probability of recession has fallen. There is a lot of stimulus that Trump is going to give to the domestic economy. Obviously, H-1B visa issues are there, but I feel that we might see some pickup in the mid cap IT space, where we are a little bit more positive. For example, semiconductors, and they are talking about defense. So those companies which support all these industries, I think mid cap IT is looking pretty good. Hiring activity is also picking up. So some of the hiring companies, companies that deal with manpower, that outlook is also brightened because of the kind of hiring that activity has started to pick up in the IT sector as a whole. So net, I feel that yes, it's a neutral for us from a portfolio allocation perspective. But I feel in this kind of market, I think IT is decently positioned.
All right, Mr. Gohil, thank you so much for joining us today and weighing in on the markets and how they're shaping up.
If you like this video, then like, share and subscribe to ET Now.